Welcome to International Securities Exchange's podcast series. Facilitated by renowned educators, ISE podcasts are intended to teach beginning as well as seasoned investors the ins and outs of trading. To find an updated list of podcasts, please visit www.ise.com/podcasts. Please be sure to listen to our important message following this episode regarding the risks of investing in exchange-traded options.
Boredom can be a very good thing with the iron condor. Time decay can be your best friend. When you see a stock that's not moving and you don't think it's going to move, the iron condor is something that you can bring from your trader toolbox, so to speak. Now, there's also the butterfly. There's also naked short straddles, naked short strangles. There's all sorts of different things. But the thing with the iron condor, you have the limited risk. The enemy of the condor is a large movement in the underlying. If all of a sudden we had this huge global event and the euro is just going haywire, either to the upside or to the downside, that's the enemy of the iron condor in the currency world. Now, implied volatility, that can be your friend or your enemy. If you got into a 6-month iron condor back in November, if you were getting into like a March or a June iron condor back in November, then implied volatility was a very good friend of yours because implied volatility has come down a lot. If volatility goes higher, then volatility is your enemy in the iron condor trade, because ultimately this is what's known as a Vega short trade. Typically, you're hoping that implied volatility goes lower. Now, volatility is just one of 6 factors of option pricing. And one thing that we recommend to people is that you understand the 6 option pricing factors before you do any trade. Now with that, if you're interested in that, feel free to contact Steve at the ISE or feel free to contact me. We can guide you to articles and webinars discussing that. But with that, volatility is something to where if it goes down, the value of the option will go down, assuming all other factors remain constant. If implied volatility goes higher, and all other factors remain constant, then the value of the option will theoretically go higher. So just have an understanding of that when you're doing any trade. Now let's build an iron condor. We're under the assumption right now that you have a basic understanding of that of a credit spread. So let's start by building a bull-put credit spread. XY, and let's do it with a stock. I show the EUI over in the example, and that's just to show how this works the exact same way in the currency world. And I'm going to show some examples on our website here in a moment. But I'm using just the numbers for XYZ stock over on the left just for sake of simplicity. XYZ stock is trading at 55. Step 1, we sell the 50 put for $2. Now, we don't feel comfortable taking on the $50 worth of risk. If we were to just sell that put with no hedge against it, we would be at risk $50, or I should say $48, because the $2 of premium you get to keep no matter what. But if you lose $48, oh, gee, thanks. That premium really doesn't help too much. So as a way of limiting risk, what we then do is we buy the 45 put for $1. So that way, if the stock does go to 0, we would lose from 50 to 45 because we're obligated to buy that stock at 50, but we bought some reinsurance protection, so to speak, at 45. So our risk is from 50 to 45. The overall credit for the trade is $1 because we got $2 as a credit at 50, but we paid $1 for a debit at 45. So for this section of the iron condor trade, your spread risk is $4. You have a $1 credit, and there's $5 between strike prices. So with that $1 credit, the credit is yours to keep no matter what. However, that $4 that's at risk, or I should say that $5 is at risk, that's how much you could lose. So $1 is yours to keep no matter what. Your risk is the difference between strike prices, and that's 5. So with that, 5 minus 1 is 4. You're risking 4 to make 1. Not a bad deal if you're right. If you're wrong, it's not quite as fun. Now, on the flip side, we also believe that XYZ stock is going to stay between 50 and 60. So what we then do is we sell a 60 call for $2. That's how we're going to get some more income on this. Now, we like the idea of selling premium because after all, we get to keep that strike. The stock goes up, the stock goes down, the premium stays in your pocket. However, if all we did was sell that 60 call option, we're naked a call. We are selling a 60 call, and if the stock goes to 160, we're obligated to sell somebody that stock for 60. We would have to go buy the stock for 160 and then sell the stock for 60 to that person to which we sold the obligation. That part's not quite as fun. And if trading naked options is something that's not for you per se, one thing that you may want to consider is buying another call as a hedge. The 65 call is trading at $1. So just like the bull put spread, this is a bear call spread. There's an overall credit of $1 on the trade. The risk of this specific trade is $4. So now we believe the stock's going to stay between 50 and 60. The same concept we're going to apply to the euro here in a minute on a live demo. But with this, we can see that the overall risk of this trade is $4. The overall risk of the bull put spread is $4. So we bring them together. When joined together, the mama bull put spread and the papa bear call spread, they make the iron condor. Well, maybe that's not a good analogy, but you get the idea. Overall, what's involved with the trade? We're long the 45 put. We're short the 50 put, and we're short the 60 call. So our range that we believe that XYZ stock's going to stay between is 50 and 60. The other protection leg that we have is the long 65 call. So by adding them together in this four-legged trade, the overall credit on the trade is $2. The overall risk and margin requirement for this trade is $3. Now the way that we got the credit is by adding the $1 credit from the put spread and the $1 credit from the call spread. 1 plus 1 is 2. That's how we got the overall credit for this trade. The overall risk and margin requirement is $3. That doesn't quite make that much sense right away. I thought, well, wait a second. We have two spreads on. We have $4 and 4. 4 and 4 is 8. Where on earth are we getting $3?
Thank you for listening to our podcast. To find more podcasts on options, stocks, alternative markets, and market data, please visit www.ise.com/podcasts.